Awesome. And we are live. Thank you, everyone, for joining us today for what will be our first Fireside Chat of 2021. I am your host, Andrew Weiner, Head of Partnerships here at iComply Investor Services. iComply is a global software provider of KYC and AML, identity and risk management solutions for financial institutions, brokers, corporate and legal services, accounting, gaming, and so much more. Before we begin today, I'd love to take a moment and let our panel introduce themselves, starting with my colleague on my right.
Hello, everyone. My name is Ramona. Very happy to be here in this fireside chat today. I am a recovering lawyer. I used to work in M&A transactions for a long time. And now from the Cayman Islands, I am setting up, a BregTech company to help with compliance. I have seen numerous transactions by US major companies into Europe and other countries, and I am hoping that I could share my experience with the audience today. Very happy to be here.
Thank you, Ramona. And returning to the panel.
Hi, I am Dimitri from Anagram Compliance, based in Germany, and I've been advising corporate clients, blockchain-related clients, on the implementation of AML policies and procedures, of the operationalization of which KYC vendor to choose, for example, how to set up proper due diligence structure in order to avoid regulatory findings. Happy to be here. Thank you a lot.
Thank you.
Great, and my name is Gene Demira. I am with the AML Shop, which is a boutique anti-money laundering consulting firm in Canada, but we do work internationally with a lot of international participants as well. I joined the AML Shop only in the last 90 days as their chief identity officer in order to help in that intersection between digital ID tools as well as the fight against financial crime and anti-money laundering system. We include an expert shopper experience, sort of like Dimitri does as well, of helping matchmake from these great solutions that are out there and improving in the marketplace with our clients in their right risk profile and networks. Prior to the AML Shop from the last 90 days, I was with Manulife, head of their AML program, and Manulife John Hancock's in Canada, US, 12 countries in Asia, with a huge investment arm globally. So I'll be touching on some global trends as well in our great conversation today. But thank you for iComply and my great panelists for a lively chat that I'm sure will be coming up over the next hour.
We've got a lot of variety on the call today. You know, Gene and I are operating on both sides of Canada. Ramona here's from the windy Cayman Islands. Dimitri's out of Germany. We're going to hear some very different perspectives about the unique nuances between our different jurisdictions on this topic today. But thank you, everyone, for joining us. Before we begin, I'd like to set the table for our audience, because today we will be discussing mergers and acquisitions, the future of enhanced due diligence. And for our viewers tuning in on YouTube, we invite you to ask the panel a question at any time. You can also find today's chat on LinkedIn Live and on Twitter at iComplyIS. Mergers and acquisitions, commonly abbreviated as M&A, are the consolidation of entities or assets through various types of financial transactions. For example, mergers, acquisitions, consolidations, tenders, purchases of assets, management acquisitions, these can all be categorized as M&A. In an M&A transaction, both the buying and selling parties have a responsibility to perform enhanced due diligence and identify any potential risk prior to completing any of the previously mentioned transactions. For the buyer, risk could be related but not limited to the seller's company and its current liabilities, its activities in the market, its beneficial owners and their AML status, or any potential warnings or sanctions that have been applied to that entity. For the seller, risk could be related but not limited to the total evaluation of their company, its assets, or the identification of the existence of the acquiring party and its beneficiaries. In an increasingly remote and globalized financial services environment, more and more of these transactions are happening outside of the boardroom, outside of the office, outside of the bank, and unfolding online between parties that potentially operate out of multiple jurisdictions like Canada, Cayman, and Germany, each with its own unique set of KYC and AML rules to adhere to. This creates a complex challenge for performing enhanced due diligence on people you may never see in countries you've never been to, and it's becoming the norm. So let's analyze this as a panel and look at these challenges, the solutions, and some of the best practices we've seen in the last year for M&A. Starting with our first question, I'll direct this to Ramona, new to our panel. How does due diligence for an M&A transaction differ from the due diligence conducted for a different type of financial transaction?
Thank you, Andrew. I would say in a word, it's in depth, it's comprehensive, it's historical even, because there is such a principle as successor liability. In an M&A transaction, you're not only buying a business, you're buying everything that the business did wrong in the past, right? So if there was a case of non-compliance or repeated occurrences of non-compliance, either with sanctions or corruption or all other instances in a country somewhere in the world where that company has a branch or an employee or something like that, the buyer inherits that. And not only that the buyer inherits that, but it inherits the financial liability of a penalty, the reputational damage that can have, like that such occurrence could have if revealed, and a lot of work to put everything together and to put everything right, remediation, right? So due diligence before the transaction closes is actually essential in diminishing those risks, managing those risks as much as possible. Anti-bribery, corruption, anti-money laundering, sanctions violations are critical areas. And not only is the buyer required to have assurances, representations, and warranties from the seller, but they are actually supposed to check these issues, remedy, coordinate, integrate the two companies and have a unified global compliance program. So it comes with a whole host of issues, not only before the acquisitions and during the acquisition, but also for 1 or 2 years thereafter, at the very least.
That is very well outlined. And when we speak about due diligence, in terms of a compliance officer or compliance money laundering reporting officer perspective, when we say due diligence, that is actually related to customer due diligence. We speak about source of funds, source of wealth. Does it make sense? Does it have an economic rationale, etc.? But when we speak about M&A due diligence, there is like you open a can of worms, literally, because as you said correctly, you're basically buying the history of the company as well. And there is a lot of factors that play into the valuation, and the due diligence process is far more elaborated. We're talking about, like, first of all, why is the owner actually selling the company? What is the economic rationale? Is there a political rationale? There could be anything. Then we talk about the complexity of the company. How many subsidiaries do they have? In which countries are these subsidiaries? Do they comply with the same, GDPR standards, data protection? Do they have any kind of, how we say in German, Leichen im Keller, so corpses in the basement that don't want to be disclosed, obviously, as we've seen with the Wirecard scandal. The money and the funds were actually all administered in the Philippines through some kind of Singapore account. Now, what is the economic rationale of that? That's a big question. So, these are some of the corpses. And even though the financials were made, the financials were audited, etc., still it happened. So back to my point, there is a lot of different factors that consist of the due diligence in an M&A process. Financials is one aspect. Technology, patents, like how this is a huge aspect, especially in times that we're living in right now. If you have Zoom and you want to acquire a stake of Zoom or 100%, how have they patented their technology? Then strategic fit. You don't buy a milk business when you're dealing in the steel industry. Doesn't make sense, right? Then who are the customers? Like, what is the target base that you're actually aiming at? How many people do they have? Are the employment contracts not breaching any corporate slavery act or whatsoever? In the UK, for example, you have a slavery act which basically forbids these kind of like minimum salary and slavery-like employment practices. Do they have legal issues? Will they have legal issues? IT security. There's so many things. Environmental issues right now. So that's why I'm saying, like, we have to also in this conversation focus on one part, because we obviously cannot cover all of it. We're not accountants. So I just wanted to say that it's a very big topic, so we just focus on some specific pieces in there.
Yeah, and summarize that, it's like due diligence is this endeavor. As we said, even when you've checked every stone that you think you can turn, there could be something in the basement that was hidden and impossible to uncover with the processes or the tools that you were using. Now, I know, Gene, you probably have some thoughts here around, best practice or approach, or just some more differences between, the due diligence for M&A versus a simple transaction for real estate.
Yeah, maybe I'll bring a sunny Canadian disposition to this one, a little bit less morbid than looking for the bodies in the basement. That being said, I completely agree with my co-panelists on this. But one thing that is interesting, I'll just call out, is like, so for example, I'm aware of one particular European company that in its due diligence exercise, ended up detecting that like they ended up doing a scan, and that European company that they're acquiring had zero exposure to the United States, as in they didn't have any interactions with the U.S. So if they don't, then why are they going to scan U.S. Requirements? They didn't have any need to, right? So their sanction requirements in the U.S. are not necessarily aligned with the same ones from the EU or UK or Canada, and even Canada to the U.S. has a lot of variance with regards to what's on their lists. And so this particular company detected that, well, you know what, we do have, there are some historical relationships with a party that's currently on the list. Those relationships were before the entity was put on the list, and there's no longer, and the residual relationship is minimal at best, which would be on the sidelines of the actual piece. So they took advantage of self-disclosure opportunities at first opportunity that they did, and they as soon as the deal closed, they instantly did the self-disclosure, and there was still basically a finding against it, and it was really good documentation. It was an agreed upon approach related to the value of that, but that reputation risk still hits. You look up that company and it has that, there's an OFAC finding related to this, even though they did everything right, they followed the right steps, they followed the right practices. And that's one of the challenges. And the other challenges is that a lot of companies over the years have done a lot of acquisitions. So how do you know that the prior acquisitions covered all these things? And some of the things that could have been buried in those basements or in those other pieces literally could be files in the basements. Back then, in the prior digital world, are items that businesses often don't do that full extensive overview. Like their audit processes will pick up certain things in the normal course of business on a go forward basis often, but they won't have that uncovering of some of those other challenges, especially when it comes to cross jurisdiction. And we're seeing more and more global impacts across, not just if you're providing a financial service, but any holding of property, any kind of relationships, and sectoral sanctions is coming into play. It depends on who your partners are. So like there's some companies that have zero exposure to certain jurisdictions until they strike a certain partnership. And then they establish a contractual relationship where they're agreeing to now perform reviews to meet the requirements of another jurisdiction in order to have that partnership. And when you have that partnership, an example could be reinsurance, for example. But there's other tools that are out there that companies do. So now instead of just scanning Canada, US, and the UK where they have a foothold, they now may scan the EU because now they have this partnership. And that, again, that added exposure then unwinds certain reputational risks for them when they do those things. But then every acquisition, they have to look multiple layers down. And I know there's going to be a lot more questions coming, so I'll hold it off there and looking forward to keep going on this.
Well, you kind of led into the next question with where we landed there, and that would be, and we'll stay on you, Gene, with this one to start. Give us some key guidelines that would be helpful to consider when considering, okay, what is my enhanced due diligence path here? for this M&A transaction. And use a generic example, but let's give people some insight over to kind of how to build this checklist of considerations of things that you should be considering. You're just muted there, Gene, sorry.
Sorry about that. Now I guess I have to take a drink is the penalty for that, right? So cheers. So thank you. No, that's a great question. So I think one of the first steps I would do is just as was touched on earlier, there's some fantastic financial accounting firms that specialize in the M&A space. And although they can be, you know what, they're extremely experienced and have some fantastic practical knowledge in there, and they cost a lot sometimes, but though that provides added protection of having that independent third-party review as opposed to having your top risk assessors bringing in that expertise is quite helpful. Outside of accounting standards and really good independent practices that you get there, sometimes those accounting firms will also give you a nice big thick set of qualifications or caveats in there or disclosures and all that, saying we're not protecting against everything. So you're wondering, okay, how much is it really protecting me? And lawyers will do quite often do the same. I'm not a lawyer. I've been accused of being one, and I take it as a compliment. And all respect to the legal community, like you can only assess what's in front of you. You cannot be a future teller and look through walls like Superman or anything like that. But I think accounting standards is a key. Obviously, if you're going financial services, you want financial crime program reviews. Like FinTrack has an examination manual. OFAC and FinCEN have some fantastic manuals and materials, and past the findings notes that are great experience pieces for doing those, and they're almost like an inventory. OSFI has outsourcing guidance too, which is kind of an interesting way of looking at it, because if you're assessing a third-party outsourcing provider, why don't you use that same tool to assess an acquisition, right? And it goes through a good inventory of like privacy, cybersecurity, and your overarching compliance management program inventories to cover. Like, is the website of the acquisition compliant with accessibility standards? Like, all of those types of things are in these inventories with these different compliance management programs. And a lot of sophisticated organizations already have those frameworks. So why don't you use that whole framework and you can apply it. Now, sometimes that work can take 3 years, right? And you don't want to hold off pieces. And sometimes you got to do that risk and do that risk-based approach. But those are some pieces that may be helpful into that mix. And sometimes if you're not going to do that assessment, do a statistical analysis of, okay, what are the odds that I'm going to have an infraction related to that their third-party auditor didn't pick up, their existing program didn't pick up, and how much would it cost me if there was one? And then do the odds. And then from that percentage, you could figure out what's it worth and how much of a risk am I taking in this acquisition in the grand scheme of things. If that risk is $5 million of an error, then, and the deal is $150 million, you factor that into the price and you move forward and you hope that you won on the right side of that bet. So financial services and a lot of deals is just like, it's a smaller version of the casino, but sometimes the bet's a bit bigger. So we'll go from there.
And Ramona, I'd love to hear your perspective as a lawyer on this.
I would add a different perspective. So the gist of what I'm trying to do at Jupiter Block, for example, is to help people understand, not only like build tools for them to automate their compliance, but help them understand the principles behind compliance, because sometimes I believe that would save a lot of cost and time. Essentially, in a case like this, conducting due diligence from an M&A transaction, it's very good to understand the risk profile of the target company and of the industry itself. A very self-aware, let's say, buyer would know exactly what factors, what red flags he's interested in or not, right? So he would know what to look for. Sometimes you can include compliance-related questions in the due diligence request that are tailored in such a way that they would betray weaknesses in the compliance systems of the target company, so that it can give you a way to investigate and to dig further and it would orient the discussion in a certain way. Again, develop a detailed plan for integrating the two companies after the closing and the steps, and planning in advance what areas would need to be covered would also give an opportunity to focus on the essentials, right? And then, of course, as soon as possible after the closing, implement that post-acquisition review that would allow the company to be sure what's bought, right? It's not as good as the preliminary due diligence, but the post-acquisition due diligence is also critical for remediation, because if anything gets discovered, remediation, prompt action, and talking to the regulators can actually save the company a penalty, and can actually help enhance the image of the company instead of the other way around. So the sooner the company sees what's in there and focuses on the critical, and of course, every company would have a risk tolerance, right? Some companies want to benefit from good opportunities on the market that need to be seized. They want to follow. We're not talking right now. We've been talking a lot about M&A, but there are different types of M&A, right? You have the M&A transactions that are called strategic, that are followed by the integration of the two businesses. But sometimes the M&A transactions are just by investment funds, private equity funds, and they don't want to integrate. They just want to buy cheap, nurture a little bit for 4 to 5 years, and then sell, for more. And for them, while it is critical to develop a due diligence system, they wouldn't have the capacity of carrying out an in-depth due diligence after the acquisition. So it's important to have some rules and guidelines on their side and some insurance coverage. A risk-based approach can save that. And actively cooperating with the lawyers and with third-party experts in due diligence can actually help trace the way forward in an optimal way, taking account of the resources and the timeline.
Absolutely. That's really, really well explained. And I'm not an expert on M&A, but it's very, very nice to hear this from the person. So I would just have one more thing to add, because I think most of the key guidelines of what to consider have already been mentioned. Just one thing that I came across, there was one customer of mine who was interested in acquiring a South African business, and he wanted to, he small business, the people in times of COVID, they didn't see each other, so it all just happened over the phone, it all happened over Zoom calls, etc. He couldn't really visit the premises. It wasn't that important because it was a blockchain related business, but the key aspect of that was for me basically to perform a proper, enhanced due diligence type of background as much as I can on the corporate structure itself, as much as I can find out from public sources. And there's a lot that you can find out on public sources, really. Like, most of the owners of business, they're not even aware of what is actually disclosed, and that might conflict with what they said to the client. And if I find this out, then, well, we have a red flag there. So if the red flags are summing up, that might be a proper deal, potential deal breaker. Anyway, I did some due diligence, and I've basically found out that the company has not officially filed their quarterly reports for 4 years. They have been even warned by the South African Business Registry. It was in the public registry. It was so easy to find, and I was just surprised no one actually dared to look at this, because it's basically staring into your eye. And then I just investigated further and basically found out that the commercial registry number, or the business registry number on the contract, was a different one than I found out in the registry. So it was the same name though. So I was like, how is this possible? Either he's lying or the commercial registry is outdated. And that's the thing also about reliability of commercial registries. Like, you don't exactly know how much you can really rely on them, if the data has been updated, etc. But anyway, I kept on digging on old names that they were denominated with, and found out that they had the same corporate registry, the same company name, under 2 different registry addresses. But the one was in liquidation and the other one was live. But the problem is that the contract that the one guy signed was for the company in liquidation. So basically, a guy would just basically buy a liquidated company or in liquidation. Can you imagine? And he would have gone through with this. And this was a very, very simple check. I was just skeptic about it. I checked on the addresses on Google Street View because obviously you can't just go and travel to South Africa. And the one area was a very busy city, like main city district, so it really looked legit. But the liquidated company was some kind of side street on the farming area. So I was like, this is BS. This cannot be true. And this was obvious, but it's not always that obvious in the real cases, because people who try to sell you stuff, they are aware of what you are going to check for. So yeah, that's a little bit of an anecdote on the side.
Well, you've created a really interesting question from the audience here that I'll throw to you to start, and we'll go for the rest of the team here for feedback. But what is most commonly overlooked, in your consulting work, as you deal with existing companies that are either modernizing or making a change or entering a new jurisdiction, and you go to look at what they're doing today? Is there something that sticks out as the most commonly or often overlooked piece of this process that are putting them at risk?
Maybe I'll stab at that one. I don't know if it's necessarily overlooked versus how do companies kind of assess and understand their risk exposures, right? So we previously touched on as a group of how you may have some particular risks that one organization may view at a higher threshold than another. I'll give one example is corruption risk. And corruption risk is often something that is a very, to match a very bad cliche, is hindsight is 2020. Well, 2020 as a year was a horrible year, but that being aside, but hindsight is 2020 really gets at right now you see something, and at that time, way back when, you may have had a very small red flag. But now, like after there's a huge corruption scandal, for example, now you see, oh my God, how could you not know that that person from Russia that owns all these real estate holdings was really tied to some potential terrorist connections, or some other watch list areas, or if a certain particular person that suddenly now has a corruption scandal into it may be buried, that opening due diligence detected that, but now it's no longer applicable. Or even some countries, like in the US, has had tax evasion as a predicate offense for money laundering for over 100 years. In Canada, it's not even 10. In many other jurisdictions, tax evasion has not been a money laundering offense. It was viewed as a challenge that the governments have to deal with, and if the person avoided taxes, then that means they had really good lawyers and accountants. But tax evasion is a different world, right? So those are the types of things now that when there's a huge corruption scandal that that gets unwound, and that's buried in an acquisition of an acquisition of an acquisition's books, like those are the pieces that how far do you deep to uncover that later on? And if you don't uncover it during a very high level, bulk level review of the worst culprits against a very large customer set, and then it comes out 4 years later, once that client comes back into the fold and wants to do some transactions based on that existing legal entity that they've held for many, many years, and it was never uncovered. And now you say, oh my God, what do? I have property from this person. I have other pieces from this that are heavy reputational risk and corruption risk that can block you from government contracts for 10 years in modern regulations. So so even in non-financial services space, if you end up having a whole bunch of government contracts and you don't do that due diligence, and you're dealing with somebody that has corruption ties, that can get you into those corruption laws, and you could lose a huge block of your business that could be worth multiples of that acquisition's worth. So those are some scary behind the scenes pieces that quite often regulators don't look at that lightly, and they don't really have much sympathy that, oh, whoops, you didn't invest an extra $5 million in that due diligence for that $500 million acquisition, you know what? You cut the corners of the $5 million. So now I'm going to fine you $500 million. Like they're not going to feel sorry about that because they see that was a part of corporate greed. But it really is that hindsight is 2020. The people at the time did what they thought was right.
That was awesome. Ramona, in your experience, as
Right.
you help businesses in the Caymans, and oh, I think I lost Ramona. All right, so we'll pause on that point. Sure, she'll rejoin the stream here shortly.
No pressure, Dimitri. Hopefully she connects back soon for that one.
That was our anchor, Gene. Oh shit.
Now, we got this. She's coming right back. There she is.
I'm sorry, everyone. I'm not sure if it was my internet connection or some kind of drop, but it was very interesting because it was just about at the time that I was trying to say that sometimes it's best to cooperate with the regulator. So someone want to for me. I have another example of a horror story. Well, two of them. And actually, the difference is in the attitude that the company has once they realize that something is wrong. And in one case, the company discovered soon that something was wrong. They did an internal investigation. They remedied. They put their compliance people at work. They remedied the situation, but they didn't tell anyone. Right, so they did it. They were a big company. They didn't tell anyone about this, and they were fined when it eventually came out, because usually things come out, and they were fined about 13 million. Of course, the regulator, in that case, it was the SEC in the US, and the regulator took into account that, you know, the company had remedied, that they had investigated, that they, you know, corrected the issue and so forth, but they were still fined. Another case where they found corruption, same sort of problem related to corruption in you know, foreign country where such problems exist. And they immediately went and told. They said, like, we discovered this. We're taking action. We're putting this together. But look, we found this. We're sorry. And the company itself did not get charged and did not get a fine. The CEO of the subsidiary in question in that country got charged, but the company itself was fine. So the moral of the story is that sometimes when things come out of the woodwork, even after 3 or 4 years, the company itself is in a better position if it investigates and then goes talk to the regulator, say, like, we've discovered this, but actually we're taking steps to remedy and we've told you about it. They come up front. Of course, this is a hard decision to make, because sometimes when you're a listed companies, when you make an internal investigation in such a situation or talk to the regulators, this is a material fact that the markets need to know about. And then you have to tell them, you know, publicly, and then it could lead to potential impact on your share, on your stock and so forth. So there are factors to consider. But generally what we've seen from the history of compliance related issues that came out after M&A transactions is that remediation and talking to the regulator is the good thing to do. The cheapest
Ramona,
thing.
I would have a question for you. So we're talking a lot of technicalities, right? We're talking about bookkeeping, accounting, IT systems, anything that is very much, more or less, quantifiable. In the due diligence process, because the question is, which guideline is the most commonly overlooked or underestimated? I don't know if I'm right with this. How about just speaking to the employees? Is that a regular part of an M&A process? And how does that happen?
Right. So it is, in certain cases, it is a part of the M&A process. It depends very much on how in-depth the M&A investigations are carried out. But typically, there would be at least a few talks with management and third-party advisors or lawyers, where the third-party advisors or lawyers carrying out the due diligence investigation would have a list of questions and the management would respond to that question. That's very important because that's even if it's by Zoom and not in person, it's still a good opportunity to see their immediate reaction to their question. Either that there's something that they should know but they don't, and you kind of see that, right, in their response. Or if they are trying to hide something, some people are really good at spotting, sort of embarrassment in terms of how the answers are formulated. So that's very useful, and a lot of people do that in the course of the due diligence investigation, and that is really a best practice. Talking to the employee is tricky because for the target company itself, it's usually not common knowledge that the company is currently in the process of being bought by someone else. And in some cases, it's not a good thing to actually tell people before it happens, because it may not happen. And they will spend their time focusing and fretting and being anxious about what's going to happen to them and so forth. So if you have certain key persons, they could be told and sign, a non-disclosure agreement that they would not speak about this internally. In some cases, in some countries, there is a works committee, for example, representing the employees that would have to be told and give an approval for the transaction to happen. So you do have some leverage there. But typically, you would not be able to go freely speak to the employees. It would have to be organized and supervised, right, but someone on the seller side. But it is a good way to have a very good knowledgeable opinion. The most discussions on the employee side happen actually with the due diligence part that's done in-house by the technical people. So because they would be forced to integrate after the merger, they would integrate with the teams. It's best that they talk beforehand, and those persons, from their experience and knowledge, would be able to spot issues that outside advisors, such as lawyers and third-party advisors, would not be able to spot. But of course, they are focused on their business, right? They wouldn't be able necessarily to spot the corruption issue that nobody heard about. And those are generally difficult to see. What they would be able to see is that, there's this person who is supposed to know, to be on top of things. It's not really on top of things. That's a red flag.
Yeah.
Right.
And you bring up a really interesting point around kind of these change management implications as these teams merge and systems change and data integrates and things happen. And you brought up Zoom, which kind of leads into this next question from the audience. As the world has gone relatively remote in almost every jurisdiction for a good 9-10 months now, we are seeing that these M&A transactions have moved online. Zoom is one of the tools that's kind of come to save the day for a lot of us. It's one of the reasons that we're all able to connect like this. So the question for the panel is, which digital tools have evolved to meet this increase of the non-face-to-face M&A transactions and the due diligence processes that are now happening and unfolding during the COVID pandemic? And this is an open question for anyone at the table.
So this is Gene here, that I probably could do a full 2 to 3 day workshop on, as you're well aware, as I specialized in the intersection of digital identification systems and practices with financial crime spaces. And I know for a fact that Dimitri is right up there with me, and we could tag team for that 3 day workshop by all means. There are some fantastic tools in the tool chest, and but the one part that I'll note right off the bat is that there's a lot of tools that are all about being contemporaneous, right? It's when the client interacts with you next, then you validate a whole bunch of tools that are both forward-facing with the client, but also behind the scenes. You have both preventative and detective controls. So for example, asking the client to take out their photo ID card and do photo ID capture requires that immediate interaction with the client. You can't do that in bulk all of a sudden for 1 million clients, 10 million clients, 15 million clients in an acquisition. But things that you could do is, if you end up having that database that has all of your clients' email addresses, all your clients' IP addresses from the last sessions, you could put their device information, and if that organization you're acquiring, if they originally did not have device fingerprinting tools into their tool chest, you might be able to take that repository and run it through one of these tools. Now, that's going to cost you a lot of money, but that investment may tell you a good telling tale as well to see if there's underlying fraud or underlying criminal actors within that client base. You might be able to run all of those emails through that email threat detection software to see, do you have could they say that they have 1 million clients, but even once you do a consolidation by email or other tools, you end up detecting, no, they don't really have 1 million. They have like 650,000, and just a lot of them have more than one account. All right. So, which is a different number of relationships. And if you're buying relationships is a huge value part of a business. That can make a big difference. If you have a whole bunch of bots that are creating fake relationships, you might be able to utilize some of these technology tools with regards to even telecom validations and the like that you might be able to do in bulk. And you can do a lot of the scrubbing against the credit bureaus or just advanced analytical tools as well. But I think there's a lot of fantastic tools in a tool chest in that investment. And some players may look at that and say, "Oh yeah, but that's really not going to detect that much," in their general view. But then that kind of decision may come to haunt them 3 years later, after that person that made that decision is no longer with the company, right? So, so those are the pieces that there's some fantastic tools that are coming into the tool chest now. Some of them, again, are the next time the client comes on board, you can do that scrubbing on a go forward basis. You can line them up with your systems, which is also a really powerful tool because some of those new alignment pieces can help you if you want to take advantage of that new 650,000 households and merge them with your 500,000 households. How do you do it? Right? How do you map them effectively and efficiently, making sure that you're not taking John Smith here, John Smith there, that live 5 blocks away from each other, that could be 2 different John Smiths. Like, how do you make sure that they're the same? You need really good resolution to do that, and identity can get the clients to do it themselves. So some of those things are really powerful for that will improve integrations, that the client can do the integration for you in many ways, which is an exciting prospect going forward. That could reduce costs of integrations and improve the attractiveness of M&A. But other pieces of it could need an investment to go forward. Sorry, Dimitri, if I stole some of your thunder there, but I'll hand it over to you too.
No, there is literally not much that I would add to this because, as you said rightly, when we speak about various identity provider, I mean. We're not gonna go anywhere. Basically, this is an own topic by itself, and happy to host some kind of seminar for 3 days. Absolutely, I'll bring a hat. I have another hat there, so we're gonna go in partner look. You have a blue one as well. Okay, that is fantastic.
Gene wears many hats.
You're on mute, but impressive collection of hats. For sure. So generally, back to the topic. There is a lot of remote identification providers out there. Make sure that you choose the one that is actually applicable to your own law, and make sure that you actually check and read it up yourself. Don't just rely on any other person. So reason for that being, in Germany, if you would have an identity provider that is only taking or validating and verifying a still image, or only a 3D check, that doesn't count. That's not sufficient for a proper verification of an identity in Germany. You would have to have an actual live video call, as same way as we have here, where the operator is asking the person of, "Oh, please show your ID," and like tilt the image so I can see the hologram, etc. So these are things that you really have to pay attention to. It is not a big investment at all. The costs of implementing these kind of systems and using them, even on a case-by-case basis, the costs have dropped significantly, because it is a lot. There is a lot of automation on this. That's like identification is one piece. Then obviously at the same time, whilst you're doing the identification, you could just do the background sanction screening check in one flow. So you're basically covering off two of the very important aspects. So you will have a lot of information about adverse media, about sanctions, potential bribery, potential tax evasion cases. You could run a separate wall check on this by Thomson Reuters, by Comply Advantage. There is several providers that offer these kind of services, and this is the initial step of the due diligence. And then if you have that taken care of, check what kind of country has what kind of transparency requirements in terms of ultimate beneficial owner. So is there anything that a person is, for example, I don't know, having a complex company structure where you have separate shareholders, they all own a minority, but each of the ones actually is owned by the same holding. So, there is a lot of investigation that you can do. Companies House has done a great job. In Germany, it's called the Transparenzregister, the Transparency Registry. So there is a lot of movement in these type of registries in Europe. So make use of them, because it's way cheaper than you could do the due diligence yourself, and you can decide how far you go.
And I actually heard 2 points as we went through these last questions here from Ramona and Gene and yourself around the other tool that we haven't talked about yet, which is case management. Because a lot of the work that we're doing in enhanced due diligence is validating that everything we have today is true, accurate, valid, and poses no risk, or at least acceptable risk. But tomorrow, what happens tomorrow? Imagine, you finish your acquisition, you've got a roster of clients, you've got new beneficial owners, and 3 of them, and the very next day, become sanctioned individuals. Without the tools in place that are notifying you and keeping you on top of monitoring the behavior of these people you have deemed as not too risky to acquire, work with, or merge with, that risk now of how good is the data? How long do we maintain it? Ramona, are you able to speak to some of these kind of money laundering pitfalls that people often overlook once they've done this initial round of due diligence?
Certainly. I certainly am able to. Many people don't realize how time-consuming is actually due diligence and anti-money laundering compliance, especially, but generally sanctions compliance for it. There are tools, and automation is the future in this respect, but there are 2 things that are, as you mentioned, critical to make sure that information remains fresh in terms of consistent monitoring and ongoing. And there you have a distinction to make based on the requirements which are applicable to the buyer into the country where the buyer operates in, right? A bank would have different requirements in terms of ongoing monitoring of its customers than it would, a commercial company that doesn't actually have any specific obligations to monitor its customers beyond the fact that it should not get, involved with any criminal activity. And then based on the risk profile of the customer, then there would be additional ongoing monitoring. So the critical step is for the senior management is to understand what the risk-based approach is, what they're playing with, what their tools are, to get the tools that they are missing in terms of technology, database monitoring, or simply tools that are just able to make their lives easier, that would present them with the list of red flags that they have detected through ongoing, running in the background, or they would present them with a list of expired identity documents that they need to request, refreshments, replacements. And the other point to understand is that these companies often are not aware of the criticality of the monitoring at the board level. So for Cayman, what I'm trying to explain people when they ask about the jurisdiction generally is like, board of directors in Cayman has lots of powers, but they also have lots of liabilities. And I'm sure this is critical everywhere in terms of the liability of a company for compliance usually lies within the board of directors. It's at the top. So of course, if you have a compliance officer, that person would have specific liability. And if you have, staff, you need to train them and they need to do their jobs and not ignore it. but the board of directors overall and the management of the company overall would be the one to get, I don't know, interrogated by the authorities, to have to engage counsel, to have to respond to any accusations of wrongdoing. So they actually need to keep themselves appraised, and have at least a risk-based general view of what the company does, and everybody who needs to be doing something is actually doing that. Be it compliance officer, data protection officer. One of the aspects related to compliance is the data protection, right? Because you can run your AML checks all you want and be in compliance on that side. And then if you don't protect the personal data of your customers, you're in breach of the data protection, and you still get fined, and there's still a risk for the company. So there are a lot of regulations, there are a lot of obligations to be in balance, and it all starts at the top and then it trickles down.
Anybody else would like to comment on that? I thought it was excellent.
I think we got it. No.
I actually think that with the 5 minutes that we have left here, and just based on kind of how we wrapped up the comments today of, what is the most general risk-based approach to M&A, we can probably say that it breaks down as identify the entity, screen for risk, identify its beneficial owners, screen them for risk, and then monitor the status of both going forward and monitor the status of the relationships you have. At the very start, this is your can. Once you get into it and you open it, the worms will come, as Dimitri said. And there's lots more things to check from there, but just overall guidance. Every risk-based approach should be thinking from this perspective when we're working remotely in a fully digital environment with very little ability to do this in-person verification that was so helpful in the past. So with that said, I want to thank our panel for just giving me your time again. It's always excellent being able to host you and add new friends and partners to the panel. And I'm going to close out, starting with Dimitri here. I'd love for you just let people know how they can find you online, how they can get in touch with you, and they want to contract you for some business.
Thanks a lot, Andrew. Yeah, you can find me on LinkedIn, Dimitri Gede, or Anagram Compliance, or just send me an email on dimitri@anagramcompliance.com. Absolutely happy to help with anything that you have on your mind in terms of compliance, AML, KYC.
Thank you, Dimitri.
Great, thanks. And similar, LinkedIn, I'm the only Gene DiMera on LinkedIn, so it makes it a little bit easier for many to dig me up. The AMLshop.ca is our website, and it outlines the different service offerings we have, both in the AML space, but also into the digital and AML system space. Some of it's similar to Dimitri, but we focus more on Canada and North America. But if I have German clients, I'll give them a call. Yeah, by all means, feel free to connect and pose us with some questions. And many thanks again to my partners on the panels and iComply.
Thank you, Gene and Ramona. Where can everybody find you?
I'm going with LinkedIn as well. I'm very active on LinkedIn. You can also find me at Jupiter Blocks, full name JB Advisory Services, SAZC, in Cayman Enterprise City. And I'm here in Cayman, actually boots on the ground, on the sand rather. And by the way, if you're interested, we are COVID-free, and you can set up shop here and build your business from Cayman, especially your tech business. We like that. We like tech. Yeah.
Excellent. Thank you, everybody, our audience, for tuning in, posing some excellent questions. Stay tuned in February around, I believe, the 18th or the 25th. We're going to run another Fireside chat. The topic will be announced on social media. We look forward to having you guys attend again. And everyone enjoy the rest of their day. Have a wonderful afternoon, evening, wherever you are. Thank you.
Thank you so much, everyone.
Thank you.